Liquidity, a trader's best friend or worst enemy. If you understand how liquidity works, you'll take better trades, avoid more losses, and make more money. But if you don't, it will bite you on your ass repetitively. In the next few minutes, you're going to learn everything you need to know to master liquidity trading and start taking better trades. So let's get to it. What is liquidity? Liquidity directly refers to orders in the market. Buy orders and sell orders. Market executions, stop losses, sell stops and buy stops, sell limits, buy limits, and everything in between. While it might not seem important for you to know what other orders are active in the market you're trading, it is. And while we don't need to go so deep as to use footprint charts to see every single real order in the market, we do want to get a good understanding of one thing: mass market psychology. See, most traders work in the same way. They see the same things, they follow the same education, and they take the same trades. If you're active on YouTube or Instagram, you might see the whole smart money concepts wave and feel that every trader in the world is using this set of concepts. But the truth is, there's a large world of traders outside of this bubble that are using the basics: support and resistance, trend lines, and chart patterns. And liquidity is most prevalent around these patterns. What we want to do is start to build an eye for seeing these patterns in the market and then working out where the orders would lie around the patterns. So for support and resistance, we'd consider that there's going to be buying at the support and selling at the resistance. We know widespread trading education suggests to put stop losses above the high or below the low, depending on whether you're buying or selling. What does this mean? Well, there's going to be a lot of stop losses in one area, and these stop losses equate to liquidity. See, when you're stopped out of a trade, what's happening is you're either having to sell your contracts back for less than you bought them for, or buy them back for more than you sold them for. So a stop loss is actually a buy or sell order. And because of mass market psychology, the patterns we've just spoke about will form a large amount of buying or selling orders in one place. Example: above this resistance, we know we most likely have a lot of stop losses that equate to buy orders. So now we know where the buy and the sell orders are, but how does this actually help us? Let me explain the broad theory behind liquidations. In the market, we have two types of participants: retail participants, which are normal people like me and you looking to make money in the market, and we have institutional participants, be it banks, trading firms, hedge funds, anything like that. And these guys trade massive multi-million-dollar orders. Now, because the market's an auction where participants sell to and buy from each other, it's impossible to open a trade unless there's someone on the other side of the position who's willing to sell or buy to or from you. So the theory goes, if institutional wants to open up a large position, they're going to need a hell of a lot of retail traders to sell to or buy from. Because your average retail trader on their own is opening positions that are 100 or 1,000 times too small for the institutional transactions. So how do they get these huge orders on? By using mass market psychology to reach into areas where a lot of buying or selling orders are waiting. See, huge orders can move the market. If you buy $1 million worth of a contract, it will move the market up momentarily due to a huge influx of demand from you. So if institutional just buys into a market, they'll end up getting staggered entries because the price will rise as they buy, which results in a terrible net position entry. It opens more risk and it reduces the potential profits they can make on the trade. So instead of just randomly buying in, if the market can reach an area where a lot of orders are waiting, liquidity can be freed up, which means a lot of the order or all of the order they want to execute can be triggered at a favorable level. In simple terms, if the market gets to here, they get a better entry on their trade. And this ability to move the market short term with large orders can be used to their favor. Let's say price is here. We have a clear support below, and we know stop losses are waiting under that level. If institutional puts on a huge sell order, that's going to drive the market lower as a massive amount of supply has just been injected into the market. That will hit the stop losses of all the buyers, which frees up a lot of sell liquidity. And well, if they want to buy, sellers are exactly who they need. Now we have a huge bunch of sellers, so institutional can use this liquidity to buy from everyone who's just been forced into a sell. And then we have a huge influx of buying pressure, so the market flies away. That is the broad theory behind liquidity. So how do we actually use this for our advantage? The first way we can benefit from this understanding of liquidity is to stop taking the obvious trades. If we see an area of support and resistance, a trend line, or a chart pattern that's prone to liquidations, we can simply avoid taking a trade in that same area as everyone else. If we avoid taking the obvious trade, this is going to save us from becoming a part of the liquidity that everyone else is grouped within. And number two, catching high probability, high reward trades. With an understanding of the mass market psychology and liquidity, what we can do is start to emulate what the institutional participants are doing. So if we know there's a lot of buyers here, we know there's quite a high chance they're going to be stopped out. But if the overall trend is suggesting buying is likely, then this liquidity could potentially be a good place to buy from. Well, how do we do that? Generally, we like to see if other confluences agree. So we can see if any clear supply or demand zones are active nearby. A demand zone under a support floor, for example, is great. Another way that we can trade out of liquidity is to follow confirmation after liquidation. If the market liquidates a low, for example, we can follow through by looking for our structure confirmation to the upside. If we get a change in the low time frame trend, we can buy to follow the high impact move to the upside. Liquidity doesn't just form around support and resistance, it also forms around trend lines and chart patterns. A lot of times, we will see the market break through a trend line indicating a reversal, only to shift back into the pro-trend direction, liquidating both the buyers of the trend line and the sellers on the break-in retest. To trade trend liquidity, I like to identify supply and demand zones in line with the trend, and then when a liquidation occurs, use these zones for real buying and selling. So instead of using the trend line for my actual trade execution, I see it as a trap, and I look for the logical supply and demand and structure-based ways to trade around it. So head on over to the chart and have a go at identifying this mass market psychology. Look for different areas of liquidity around support and resistance trend lines and chart patterns, and have a go at backtesting the outcomes and the scenarios so that you can build an eye for this and start to trade this in real time. And if you want to learn more, head to the link in the description and join my free course. With that said, I'm out. I'll see you in the next video.